So without much ado, turning this over to Blake, is dollar yen still the best FX pair in FX for risk?
Well, thank you very much, Boris. And I want to say, Chris, what a great great presentation that was. And I wish you would have put me behind like an accountant or something that would have put everybody. It would have made my job a lot easier being able to present after somebody like that. But Chris had a wonderful presentation on volatility, and as you probably have witnessed, Boris, volatility has obviously picked up quite a bit over the last 2 weeks, and it's made a hell of a difference in my trading personally, and I think we've all, as traders, really welcomed it.
Hallelujah! I have
Yes.
been waiting for this for a long time.
It's been, it's been a tough 2019. I guess before I even start, I want to say that I'm the founder of Forex Analytics. We put it together several years back when I left Ally Financial, and when I was the chief currency strategist for the firms previous till we got acquired by Ally Financial, and I also trade for a company called Gellos Capital out of Greenwich, Connecticut, and which is a small boutique firm and I've been trading for them for the last several years. But I'm going to tell you that the last year, I would say last year, volatility has been really low, and it's been difficult. It's been my lowest productivity for the last several years, and it's not because of the way that I trade. It's just because there has not been as many opportunities in the market. But the good news is right now in my opinion, we're at a very pivotal point in the markets where this presentation specifically is going to be very relevant due to the S&P, and also with volatility picking up, and the very timely presentation by Chris. We're all welcoming that, and now we need to see what kind of opportunities are going to present themselves as the market does pick up in volatility. And this is where my presentation about, is the dollar yen still the best FX pair to trade for risk? I feel it's super relevant based on where the S&P is historically. And so, without further ado, let's talk about the markets and correlations in general. Now, you guys have probably heard that there are a lot of correlations in the markets that are extremely important, and I really live on correlations, and I always have in the markets. And from a statistical standpoint, you've probably heard the saying, correlation does not imply causation, which means just because something happens, something else is not necessarily going to happen. However, I talk about, in my own daily webinars, which we host free daily webinars every day with Forex Analytics, so we can give you a quick update of what we're seeing in the day ahead. I talk about the domino effect, and the domino effect in the market is real simple. Is if something happens in the market, what else could possibly happen? And I look at it kind of like a puzzle. Every day, it's like I've got this jigsaw puzzle, a bunch of pieces sitting in front of me. Every time I get up and I turn on Bloomberg, and I've got multiple screens of just charts and data, and I'm reading bank research. I look at it like, okay, I've got all these puzzle pieces, and now I have to start putting it all together, or like a domino. And if one domino falls or one domino moves, what's going to be the effect following the market? And that's where correlations really come into play, in my opinion. So, that comes back to the original question: is the dollar yen the best correlated FX pair to trade to the S&P? Because one of the charts that I'm always looking at, and even as an FX trader predominantly, and I'm not saying that I don't trade S&Ps, because I do. I tend to trade the futures contract when I do it. I'm always looking at the S&P, and then I'm trying to figure out, okay, well, what is the best correlation to the S&P if the S&P starts to move? And as you can see, this is a recent chart, and this is from 2014 to present. When I say present, I think I took this picture a few days ago, at least a couple of days ago, and you can see the most recent move down in the equity markets has caused a move down in the S&P. But what you'll notice in this specific correlation, and by the way, what we're looking at here is the dollar yen is the orange line chart. The candlestick chart, well, it's not really candlesticks when you compress them this tight, but that's the S&P. So you can see the S&P has been rallying, and the dollar yen is overlaid over the top of that specific chart. But what do you notice that's happened since 2017? Since the beginning of 2017, we've seen a continued rise in the S&P, but you've seen the dollar yen basically go flat. So when you have this normal correlation of the dollar yen and the S&P moving together, you see that divergence has really taken hold since the beginning of 2017. So I guess the question that I would ask you as a trader is, what changed? And I know Boris, even though he's not gonna say anything right at this moment in time probably, but he knows exactly what changed in 2017. I think most of you know. But Donald Trump was elected as president of the United States. And so what happened at that point in time, at the end of 2016, once the election took place, is you saw the stock market take off. And the stock market has continued to rally since then. Well, minus this decline that we've seen in the S&P last year, but the S&P has been trending higher. A lot of that is due to the market's optimism that President Trump is going to be good for equities. But what we've seen in the dollar yen is less of a response. So the FX market is more, immune to what's happening in American politics versus stocks. And you guys hear it all the time. And stocks continuously rise based on expectations of what the current administration is going to do on trade and yada yada yada. All right, so there's that, and that factor's really played into the market. So if you look at the end of 2013 to December 2016, and you see what stocks going, looking at this a little bit closer up, you see equities are the candlestick charts. The line chart here is the dollar yen. You can see a very strong correlation. As stocks come down, the dollar yen will come down. If the S&P starts trending higher again, the dollar yen will eventually catch up, or vice versa. We'll see one pull down and the other one pull down. Very, very strong correlations. But again, this is the end of 2016. When we had the election, and you can see that the S&P has been on the rise, and the dollar yen has really not responded. Okay, so when I think about those correlations, I have to go, well, how about the dollar yen and the Nikkei? Because when you're taking the dollar yen, you want to pair it up with the Nikkei, as it's strongly correlated to that particular market, and you'll notice that the correlation is much stronger. Okay, and this is a correlation between the dollar yen and the Nikkei currently, and this is from the end of 2009 to present. Now, if you overlay the three of them, okay, what you'll notice here is the S&P, which happens to be in the yellow, okay, and then you have the Nikkei and then the dollar yen all matched up. You still have a very strong correlation between the Nikkei and the dollar yen, but the S&P has kind of pulled higher since then. But what I've noticed most recently is the correlation is still very strong. But what you'll notice in those charts is the downside in the dollar yen and the S&P may be stronger in the months ahead, because what happens is you're seeing the S&P, when it comes down, since the dollar yen hasn't rallied, you'll see the dollar yen pull down as the S&P starts to hiccup a little bit. And we've actually seen it in the last couple of weeks. We've seen the S&P, come off of the all-time highs, and then the dollar yen has been quicker to respond to the downside versus the upside. So when I look at the dollar yen and the S&P, I start thinking, okay, if the S&P goes higher, I'm going to be less apt to trade the dollar yen to the long side, but I might be more apt to trade the dollar yen to the short side if the S&P is coming down. And again, this is so relevant because as you'll see in the charts that we go through, the S&P might be in a topping pattern. So if it is, and we still see that downside in the S&P from here, the dollar yen might be the better trade. And moving forward, the dollar yen, the best correlation would be the dollar yen and the Nikkei. So when you think about the dollar yen and the S&P, if it's still best correlated, I want to take a look at bank rates, because if you think about currencies, the ultimate driver in the currency market is going to be interest rates. As interest rates come up or interest rates grow down over time, that's going to be the predominant driver of the market. But there's more to see than just, are rates going up or going down, or expectations going up or going down, because you have to think about where rates are currently, where they've been, and where they may go. So this is, this is a lot of the central banks from investing.com, and I'm gonna take your focus away from the top three, because when you're talking about the ruble, and Brazil and India's currency, as retail traders, we typically don't trade those. So I'm gonna black those out for a moment. But I want you to see what we have here between the Fed, the Bank of Canada, the RBA, the RBNZ, Bank of England, ECB, BOJ, and Swiss National Bank. All right, which are predominant currency pairs that most of us that trade the FX market are dealing with, for the most part. Notice that the Fed rates are at 2.25. Okay, Bank of Canada after that, and then and it escalates down, and then from there we have the ECB, the BOJ, and the Swiss National Bank, either at zero or negative interest rates still. Okay, now the reason why this is so important is because what I like to look at as a currency trader is I try to think about what currencies right now are used as funding currencies in the market. Okay, what I mean by that is if a central bank like the ECB offers 0% on reserves, okay, institutions around the globe and banks around the globe are more likely to deploy euros and invest them elsewhere. They're going to put them in, whether it's in equities, or they're going to put them in, other central banks. They're just not going to keep their money at zero. So people are going to, not be in euros and deploy them elsewhere. Same with like the Swiss National Bank. I mean, if you hold your money over in Swiss francs, you're actually not getting interest. You're paying interest holding your money there. So no one that's been the Swiss National Bank's tactic over the last so many years is they're just trying to get people not to be buying Swiss francs. So and if as a retail trader, it's hard to buy Swiss francs, because if you buy them, you're going to have to pay a rollover, and you're going to have to pay interest on those Swiss francs on a daily basis. And heck, if you hold it on Wednesday and you get triple rollover for the weekend, it becomes quite expensive. And if you're trading on the size of some of the sizing that I trade on, it becomes really expensive. So I tend not to buy Swiss francs unless I really need to. But on these other currencies, you can hold them. You can hold dollars. You can say, oh, I don't mind being long the dollar. But if institutions need to reverse out of these positions because risk appetite is not so strong, you're going to see some of these trades unwind. And that's why currently I start looking at some of these currencies that have, and some of these central banks that have higher rates, and I try to think about what would happen if risk reverses or the S&P reverses, for example, and traders need to unwind some of these positions. Now, one other central bank that's not on here that I wanted to talk about would be, this is the Mexican currency and the peso. And what you'll see here is rates are still, above 8%. So, and this is one currency I really will focus on as we go into the live charts, because as Mexico has their rates above 8%, that becomes a risk. Should stocks start to unwind, you might see a bigger outsized move in the Mexican peso or some emerging market currencies than you would in some of the G10 type of currencies. All right. So one of the, I want to talk a little bit about the dollar and its safe haven status. All right. A lot of traders come to me, they still remember the financial crisis. They remember, they think about 2007, 2008, and they remember the time, and they continue to live in the past and say, oh yeah, I remember when the S&P, you can see, S&P went from 1600, we went down to 666. The dollar ripped. You can see this is the dollar index. It's in the orange. It just ripped. It almost doubled, and there was this massive liquidity issue, and the dollar just rallied. And a lot of people continue to live in that, in the past, and say, the dollar at some point is going to rally. If stocks, come down, the dollar is going to rally. And I tend to agree with that. But what we haven't seen, in years, is we haven't seen the stock market really come down. This is the S&P, and if you look since the financial crisis, since 2000, the bottom we formed here in 2009, the S&P has gone straight up. So we haven't had a real opportunity to see what the dollar would do if stocks come down, because, well, frankly, we just haven't seen the stock market come down. And if you think about, what the dollar has done, this is the dollar matched up to the S&P. You can see the dollar index at the same time, matched up to the S&P. It's been, kind of mixed. We've seen the dollar move up a little bit here in 2014, 2015, and, into 2017. But you have to ask, why did that happen? Well, the reason why that happened is because the Fed really was the only central bank raising rates. Now think about that. Okay, the Fed has been raising rates, and I know a lot of you go, oh yeah, well, Fed raised rates because they wanted to put some bullets back in the chamber, for lack of better terms. They wanted to make sure that they had some ammunition to fight if we start to see a global slowdown. But what has happened is no other central bank has really moved rates, right? Like you look at the ECB, they've been at zero. You look at the the RBA and the RBNZ, they haven't gone anywhere. The Bank of England either. The Fed has been really the central bank that has been raising rates, and the dollar has responded appropriately. But now it's like, okay, well, the S&P is where we're currently at, and the dollar is just kind of stagnating. That's because the Fed really hasn't done anything recently. And now, the Fed is talking about, or is now starting to lower rates again. But the question goes back to, well, what happens, if the stock market sells off? So the most recent period of time you could see here, last year at the end of 2018, we had a correction in the S&P, right? We had a 20% correction in the S&P. You can see the S&P is in the candlestick chart. The dollar index, the DXY, is in orange. When the S&P sold off, the dollar index didn't do anything. All right, it didn't. It stayed there, and a lot of people wondered why that is. Well, in my opinion, after this 20% correction, we're not seeing the dollar do anything. In order for the dollar to really respond to any type of weakness that we see in equities, we have to break technically that long-term trend line, or in other words, we're going to have to actually print a lower low in the S&P longer term, and then at that point in time I will start thinking again that the dollar may come back as a safe haven currency. But until then, I'm less apt to look at the dollar as the stock market's coming down, I need to buy dollars, because that's still a pretty common idea amongst traders, believe it or not. Here we are almost 10 years later. People are like, oh, the stock market's come down, I need to buy dollars. That's not necessarily the case. All right, and I don't believe that to be the case unless the S&P actually starts breaking lower through some of these supports. So if you go back to the question, is the dollar yen the best correlated FX pair trade versus the S&P? What I wanted to do is I wanted to actually go through some charts here and take a look. Okay, so once again, here's the S&P, and this is the chart that we were just looking at. And we were just looking at this, and by the way, all these charts I'm going to be doing a little bit of technical work with you. Okay, so here we have the S&P, that long-term trend line, and you can argue that we may be going higher. We may have peaked. I personally think the risk is starting to build that we may have peaked in the market, and really technically, let's go over to the weekly chart really fast with the S&P. If you take this move, the financial crisis move, right, from 07 to 09, you'll notice that just above where we're currently at in the S&P is a 261% Fibonacci extension, which for me is a very, very significant extension in the market. So we came within striking distance of that level in the S&P. Then if you look at let me revert these charts. You look at the move in 2018 and you take the high to low. We're near the 127% extension. Whoops. The 127% extension of the move. We came pretty close. We hit new highs, maybe false breakout. Did we create a false breakout, or can we still go higher? That's to be seen. And I think a lot of that comes with whether or not the China and the U.S. are gonna have a trade deal, going into this next year. Everybody's got opinions on that, and my opinion is, if I was Donald Trump and I was running for re-election, what I'd probably do is try to stall a trade deal, and then use that as political clout to say, in order for me to be re-elected, you have to re-elect me because you want me to finish off this trade deal with China, because if not, it's gonna be trouble for the market. So I don't know if we're gonna reach all-time highs, or maybe he will get a deal done before his election campaign and try to get something done. And if he does, could the S&P hit new highs? And that's really the risk here. But if we have peaked, and let's just say for argument's sake, there is no China-US trade deal and we have peaked, then we start looking around saying, okay, well, what are the currency pairs that we could possibly trade if the S&P does indeed start trading, from here. Let's say we start trading lower. That's when I start looking at currencies like, the dollar yen, which first and foremost, we'll look at the dollar yen. And the dollar yen, in my opinion, we are at risk of continuing to break lower. And we've seen the S&P starting to show some signs of, fatigue on the upside. And with the dollar yen, this is a weekly chart, by the way. What we're seeing is that dollar yen break down out of a triangle consolidation that we've had for the last 3 years. 3, you can arguably say it's even longer than that. And some of you might say, well, yeah, Blake, but can't you go all the way back here? You could, but the fact of the matter is we're starting to break to the downside. So again, my opinion is if the S&P is indeed starting to come off, the dollar yen may be one of the better trades to trade to the downside. As the S&P comes off, I think this is a realistic, expectation for the dollar yen moving forward. And also, you think about like some of these supports down here at 104.50, 105, if those levels start to break, then you technically start making lower lows. And, we break below that spike low that happened, I think it was January 2nd of this year. We start breaking at 2019 lows. Now you're actually making not only lower highs, but you're making lower lows, which, in essence is a shift in trend. And in this case would be to the downtrend. Now, a lot of you might go, well, if I trade the dollar yen to the downside, how effective will it be if I trade like the euro yen? Because you can see the euro yen is already starting to show signs of weakness. But I'm going to go back to the comments that I made a little bit earlier about the European Central Bank. The ECB, remember, they've had rates at 0. Okay, they've had rates at 0, and if stocks really start to come down, my opinion would be that the euro might unexpectedly be stronger than you'd think. So, and I'm going to go to the euro here in just one second, because this is something that myself and our firm, we talk about on a daily basis is, what if we have to see some repatriation, if you will, of euro dollars? Then if you've got the euro yen technically breaking down, okay, will the downside continue in the euro yen? Will it continue, or will we have some stabilization here in the euro yen, where most people would be like, oh, stocks are coming down, I'm going to go ahead and short the euro yen, that seems like a natural trade? My opinion might be that, hey, the euro may not be the best short. The dollar yen may be a great short, but the euro yen may not be the best short out there, because if you look at the euro dollar, okay, and this is a weekly chart of the euro dollar, we are in a descending wedge, right? Now, for those of you that follow, I'm a very basic technical analysis guy. I've been trading since the mid 90s. So, and my charts, and those of you that listen to me on a daily basis, you listen to our daily webinars. The one thing that I know you can count on me is that I don't change things up. I look at charts in a very simple fashion. I've looked at them the same way for years, and it's always done me well, because I'm a big advocate of the KISS theory and just keeping it simple. And I don't use really unorthodox technical analysis. I just use very basic technical analysis, but it's always served me well, because I do just keep it very simple. And for those of you that use Forex Analytics, you know that our basic technical analysis and the analysis that I provide on a daily basis there is really going to show you as such, using relative strength and a couple, the 50-day and the 200-day moving averages that you see here, and basic technical charts, like in this case would be a descending wedge. Now, a descending wedge in technical terms is a reversal pattern by definition. Now, it's a downtrend, it's in a downtrend until it's not, meaning that once we take out this downtrend line, it becomes quite bullish. And my suspicion is, if stocks start to sell off, one of the currencies that may be the unexpected star performer might be the euro. And if you go back to like Chris Weston's presentation just before this one, at the very end, he was talking about the CFTC data and how the market's extremely short the cable or the pound, and the market's short euros. That there's and if you think from a macro viewpoint, there's not a lot of people that want to be long euros. if you're talking about Italian debt, or where the European Central Bank has rates and they're not expected to raise rates. And but if the ECB keeps the rates at 0 and the Fed continues to lower rates, that there you get your expectation shift of the euro may continue to strengthen against the dollar. But more importantly is the market is positioned on the short side of the euro. And if institutions need to, get out of their euro positions, their short positions, and come back into the euro, repatriate, if you will, we could see the euro unexpectedly start to strengthen. And this is why, for me, I'm not necessarily looking at the euro yen as a great short. The dollar yen may be a great short, but the euro yen is more questionable to me. And I think that we might actually end up moving sideways in the market in the euro yen versus it going down aggressively with the S&P, which most traders I think would expect. All right, so the euro is one of those currencies that has to be on your radar in case the S&P does come down. Now, staying with the theme of some of the major currencies, I look at the cable, and a lot of you would probably ask me, well, how about the pound? How do you feel about the pound? Look, I'm going to tell you right now that I'm staying away from the pound, and with a possible hard Brexit on the horizon, I don't know if there's any reason to be long the pound right now. And I know I know for traders, we're all guilty of looking at currencies that you might feel are oversold or overextended, and they might be ripe for a reversal. Look, if we had a headline that hit the wires that there's been an agreement, it's not going to be a hard Brexit, I'll be the first one turning around and buying the cable. I will be. But unless I see some concrete evidence that I should be buying the cable, there's no reason for me right now to be looking at it. And I've been leaving it alone. And I mean, I've watched the bloodbath on a daily basis in the pound. I'm like, thank goodness I'm not long. And the next question you may ask me is, well, if you're not long, why won't you just be short? Well, the fact of the matter is I don't want some news headline to hit the wires and me be stuck on the short side of the cable either. So I think there's a situation where, yes, it's too oversold to be it's too weak to be bought, yet it's too oversold to be sold. That's kind of like one of the current situations I feel with the pound. So therefore I tend to leave it alone. But going back to go ahead. Yes.
Do you mind if I chime in?
Yes, absolutely.
Your analysis kind of dovetails very similarly with mine. I just wanted to expand a little bit on this. So let's take a look at cable first.
Yeah.
So there's clearly an upside risk. I think the upside risk here is that no deal Brexit gets taken off the table. It's looking actually bleaker and bleaker by the day, simply because Boris Johnson seems to be really pushing the country to the brink. But the underlying bet in the market, I think, is still that saner voices will prevail. If you look at the technical picture of cable, though, what's interesting is if you pull back to the weeklies, go back all the way. Oh well, no. So you are there. I'm sorry. You are there. I was just looking. The point of support is actually 119. So when you're looking for the shorts here, is it possible that it's very, very possible that we take out the 120s. There's just way too much temptation for the 120 stops not to be run. And of course, the flush there then takes us to that terminal point of 119. But the 119 is the true support point here on the charts. That's where I think it's going to become very interesting. That's really going to be the support line, the marginal line between all bets are off and UK is spinning out of Europe, or we're just going to wait a little bit longer, see leave the election cycle, see the second referendum, see whatever is happening, see Brussels come to the table, and consolidation there. And that's, I think, how you got to think about this. The downside right now is essentially 100 points max, unless you are 100% convinced that UK will no longer be part of Europe.
And I agree with you, and I'm not, and I didn't want to spend a lot of time talking about the cable. However, I'm in agreement with you that this could be, in the current time frame of the next, let's say, 6 months, this could end up being the trade, one of those, generational trades for all of us that are participating, especially if we end up getting, everybody expects there's going to be a no deal Brexit, but you then in the back of your mind you always think, okay, cooler heads are going to prevail, they're going to figure out something before it gets done. But that's been a lot of people's arguments since we've been trading in the mid 130s. So the fact of the matter is, if we do get a resolution, the cable will reverse, and we get a no deal, or we get a Brexit, not a hard Brexit, but a deal, is in place. This is going to be probably one of the best longs for all of us that are trading, but
It'll,
until
yeah,
that happens,
right. It'll certainly be good for 300-400 points of a short squeeze, maybe even more. Because I think I think everybody agrees that under normal customs union conditions, it's a 125, maybe even 130 trade, simply because actually the UK economy, despite all the punches it has taken, has not crumbled just yet, but it is already starting to crumble. It's already
sure.
starting to feel the impact of a hard exit. One other note I kind of just want to talk about, as you're looking at euro, I'm very much also in a similar agreement with euro. The euro is interesting from a lot of perspective. Yes, it's a falling wedge, but if you just zoom in on this, just from a pure candlestick perspective, it's a pin bar right there. Look at that pin bar on the weeklies. We had a mass. They rejected the 110s very, very strongly.
Very
On
much so, and it was a false breakdown too.
false breakdown. Now, there's a million reasons why that could happen. There's still a million reasons why it could go down. But for now, I think from a fundamental point of view, one of the more interesting things to think about, and this is why they always say generals fight the last war. You were talking about how everybody's thinking about the great financial crisis and how the dollar was the trade into safe haven. Well,
Sure.
the situation is completely different now. If you look at the balance sheet of the two regions, the European balance sheet is far healthier than the US balance sheet. We're running $1 trillion deficit right now with a massive, massive trade deficit. And this is very, very important from a political point of view, no longer the safe political place that we used to be because of incredible tensions in the country. Euro, on the other hand, for all of its troubles, yeah, it has anemic growth, but it's because of Germany. It's running a massive trade surplus. It is actually a positive surplus currency. That's one of the reasons why you could have that surprising move to the upside that people just don't expect.
Yeah, I think there's, and I think it'd be a very surprising move to a lot of people, and this is why I think we have to think about where we're currently at in the current environment, and think about the possibilities here. And technically, I think the market was caught off guard when we broke below 111, and then we did get that pin bar, and we closed on a false breakdown premise. I think the risk of the euro could be to the upside here, and I know the euro's trapped by a lot of gamma, a lot of options are placed around current levels, but that's not going to contain the euro forever. Let's just all realize that. And for those of us like Boris and myself that have been in the FX market for so many years, we know that the options market can trap spot price for only so long, and then it'll loosen up. And once it loosens up, surprisingly might be actually to the upside. So I think we've got to keep that in mind, moving forward.
So I was going to say, if you don't mind, you may want to. Everybody is very interested in the website that you guys run, the Forex Analytic Market Analysis website. And if you have a couple of minutes, maybe you could just walk the group through what you guys do on a day-to-day basis, how your room plays out. I think everybody would definitely be interested in. And then I'll see if there's any questions after all that.
Sure, we'll do. Before I do that, I'll take you over to the Forex Analytics website, and thank you, Boris, for that. One trade, a couple trades I really want you guys to focus on, just because we talk about the dollar Mexican peso, and I was referencing how the interest rates at 8%, right? and one of the biggest carry trades out there has been the Euro Mexican peso, which also I have down here. You can see the Euro Mex right here. If these have to unwind and you start to see, you know, a sell-off in the S&P, well, what you would see is a downdraft in the peso, and the dollar mex is in a very tight triangle consolidation, and a break above 20 would be extremely bullish for this particular pair. And along with not just, you know, the euro Mexican peso, which we've seen those unwinds happen as volatility picks up, and it's very strongly correlated to volatility. As volatility picks up, the euro Mexican peso starts to rally. But if you look at some of these other currencies, like, you know, you have the Euro New Zealand, which we just saw the RBNZ, you know, they're talking about negative interest rates. And that's quite a fall from grace if you talk about the RBNZ in 2011, where the rates were 8%, and now we're at 1%, possibly going negative. And if you have an upside risk in the euro, you take a currency pair like the Euro New Zealand, think about like the explosive moves that we could see here if the RBNZ decides to take the rates even lower and the euro, you know, starts to come under upside pressure as you see, you know, people unwind the euro being deployed for so many years with the ECB at 0. If people start buying back euros and they continue to sell New Zealand dollars, we could actually see a very strong rally in not only the Euro New Zealand, you know, possibly the Euro Aussie as well. And I know we have a lot of Australian listeners here right now, and think about where we're at now and where we have been in the past. And this is very much a potential risk-off trade if we see the euro rally. So I guess the focus I wanted to bring you to is, you know, some of these euro crosses. Now, Boris had you know, asked me to mention about Forex Analytics. So this is the Forex Analytics platform, as you see here. If you ever want to register for our daily webinars, we perform them for free every day. You don't necessarily have to be a member to listen to our face webinar. But when you log in, what you'll notice is, let me go ahead and log in. Whoops. Let's make sure I'm logged in correctly, which I'm not. That is not correct. Hold on. Oh, excuse me. All right, so that was our audio for that. What you'll see, here's the Forex Analytics platform. And what you'll notice here is that we cover 30 different instruments. And what we're covering is multiple methods of analysis, whether it's macro, candlestick, basic technical, harmonic, Elliott wave analysis, and you can click on any one of these analysis indicators and you can flip through them, you know, whether you're looking at harmonics, Elliott waves, our basic technical, and you can see all the different charts that we upload throughout the course of the week. And all this analysis that you see here starts each week. We you know, delete it so it just doesn't, you know, doesn't become overbearing, and we take off the charts that aren't relevant anymore at the end of the week. And we start off with a new week, and you can see all the analysis here. And what we try to do at Forex Analytics is apply multiple forms of analysis and try to get them to match up, because that's going to improve statistically if you have several methods of analysis matching up the same direction. You know, it's easier to trade directionally in a pair. But we have we have all these different pairs, but we also cover the S&P. You know, we cover the S&P charts. We have analysis throughout the course of the week, because I'm a very strong believer in correlation. So, you know, from, you know, cryptocurrencies, we just have some cryptocurrencies in there because of the demand, but we have, you know, precious metals, crude oil, the DAX, bonds, boons, and, you know, the epic rise in the boon market. You can see, you know, that, you know, and how it's affecting the markets. And we're constantly talking about correlations in Forex Analytics. But the platform, you know, we get all this analysis. We have, you know, calendars and Twitter updates, and, you know, you can have a customizable Twitter platform here, and our, you know, chat room where we have all of our traders logged in live throughout the course of the week. And there's probably about 100 of us that are chatting all day long in our chat rooms. You can see I'm extremely active in there, and you'll see like my face in there all the time. That's me right there. But our platforms are also mobile too. So we have apps that are on, your tablet or on your PC, or excuse me, on your mobile device. So when you get a new update, you get a push notification. If the support and resistance levels are breached, you'll get notifications as well. And for those of you that are listening in, we have a special offer, which we're giving a 65% discount for a month. So you can try it out for a month at a 65% discount and see if it's right for you. And that's specifically for the
I'm sending that link right now to everybody in the group, so you guys can all have it.
Perfect. Thank you.
Okay, you guys should all be set. Okay. So thank you so much. It's an amazing website, really, really great analytics. I have made Blake my go-to follow now every single day. Let me just see if there's any. I'm just trying to see what questions we have here. They're just mostly comments. People are saying, well, some people are predicting a 4,000 move to S&P before we turn down. Other people are saying, triangles are not terminal moves that require a pullback. Honestly, guys, it's all. I'll let Blake answer that. I mean, it's all speculation. That's the whole point. Every day we come to the market with a certain assumption, and if the market changes, our assumptions change. At least that's what we do as good traders. So we're just simply sketching out what we see as a most likely scenario, which can easily change 150 degrees, 180 degrees if new piece of information comes in.
Oh, on a day-to-day basis. I mean, this is my long-term bias or your thesis on the market, but that doesn't mean that we're in such a fast, ever-changing world, especially with the current administration in the U.S. Obviously, you have to stay very close to Twitter and close to the headlines and be watching them carefully, because the rules to the game can change at a moment's notice. But that's the great thing about being a trader, is my opinions can change at a moment's notice too. And I can try to predict all day long on what I think is going to happen. But one thing's for certain, Boris, and I'm sure you would agree with this, being in the FX market, for 20 years plus 20 plus years, in probably your case, interest rates do drive currencies and movements, and interest rates expectations. And the fact of the matter is that most central banks are at zero. The Fed is not. And the Fed may be moving rates lower moving forward. And they've already signaled that they're starting to do that. But if you see, other central banks like the RBNZ, the RBA start to, race to zero, I think the Fed will be right behind them. And that's going to affect the rates and the currency market the way we see it right now.
I agree. I also think that we're sort of still living in that dream world of carry trade, when the economy was normal, when rates were normal, when global expansion, contraction markets were normal. None of those things are normal. I think the strongest thematic idea I've had, and I not that I wanted to have this idea, and I've really actually never wanted this to come true, but it just seems to be coming truer and truer and truer and truer, is that we're all turning Japanese. This is what's insane, is that we're all in a world of, we have these two massive trends in the world that are utterly irreconcilable. In the advanced industrialized world, everybody is getting much older, and technology is getting much better, and demand is getting much worse. Because when people get old, the only demand they have is adult diapers. And the other incredibly societally disjoining variable is that old people are rich people, young people are poor people, old people do no work, take all the assets in this world. And I speak this as an old person, because I'm at this age, but I just think that if you think about it, 90% of all welfare in the industrial, so this I'm talking about the G20 universe, goes to old people. That's how it works. They get all the health care, they get all the pensions, they get all the benefits of the years, and all the poor people, all the young people get nothing. And I think that distinction is really creating some incredibly skewed economic policies that we're running from. But that's a conversation for another. And I will leave everybody with those thoughts.